REITs have rallied in recent weeks, and as a result, some investors seem to think that now it's too late to invest in them, but the reality is that REITs have been in a bear market for over 2 years. They dropped by nearly 40% at their lowest point, and therefore it would take a lot more than the recent rally for REITs to fully recover. Moreover, I would add that the chart that you see on the screen is the average performance of the REIT sector. It's the Vanguard Real Estate ETF, which is dominated by mega cap investment grade rated REITs like Prologis, Public Storage, and Realty Income. Those REITs have already strongly recovered, but there are a lot of smaller and lesser known REITs that have weaker balance sheets that have crashed a lot more than those bigger REITs, and those still offer significant upside potential in the recovery. Some of those smaller REITs dropped by 60, 70 or even 80% from their peak and could still triple just to recover to where they were a few years ago. Hey, this is Yussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to highlight 2 REITs that have the potential to triple in the coming years as we recover from this bear market. But as you go through this video, keep in mind that these are high risk, high reward type investments. You don't get this potential of upside without taking significant risks, and these 2 companies are no exception. The first company I'm going to discuss here is called Branicks. Its ticker symbol was BRNK. This is a German real estate investment firm. It traded at around 18 euros as its peak, but then came the pandemic, interest rate surge, and today it's priced at just around 2 euros. Its share price has already doubled in this recent rally, but it still offers very significant potential if it can just survive this crisis and return to a more normal valuation. The company just recently announced its results, and its latest net asset value estimate is 17 euros and 31 cents, which essentially means that it's today priced at an 80% discount to its net asset value, and so the share price would need to far more than triple to return to its net asset value. It also trades at just around 4 times its expected cash flow this year. So why is it so incredibly cheap? And the answer is pretty simple. It is its balance sheet. The company came over leveraged into this rate hiking cycle, and as a result it's today at risk of not managing to refinance its debt, and it could even go bankrupt. Its loan to value is 58.8%, which leaves very little room for error. It's very close to breaching its LTV covenant of 60%. The market clearly thinks that there is a higher risk of this covenant being breached and the company going into bankruptcy, and this explains why it's priced at such a steep discount to its net asset value, since if the company is going to default on its debt, then no share price is low enough as it would go down to 0. But while I admit that risks are high and bankruptcy is a real potential outcome, I am more optimistic than the market and think that Branicks is quite likely to survive. Last week I attended the EPRA Rethink conference in Berlin, Germany, and one of the main takeaways there was that cap rates have now stabilized, rents keep on growing, and therefore property values have now stabilized and are expected to even start rising in the near term. This is especially true as interest rates are now also being cut quite aggressively, and so taking all of this account, it's expected that the LTV, the loan to value of Branicks, will now return to lower level organically as property values increase a bit, and on top of that it will also lead to a recovery in the transaction market, which will allow Branicks to sell more properties to pay off more debt. On this end, the company has already made a lot of progress. They've announced 360 million worth of property dispositions, at least of what's been announced so far, and they expect to sell another 300 to 600 million worth of properties this year alone. These asset sales, coupled with 40 to 50 million worth of cash flow they expect to generate this year, should allow the company to repay its 2024 maturities and a good chunk of 2025 as well. You will note from the chart on the screen that the most expensive debt of the company is the one that's expiring this year. It has an interest rate of 7.4%. This is its bridge loan. It's a short-term debt, so it has a high interest rate, and so this is a good thing in a way because that's the debt that it's expected to repay in the near term, and it should actually be accretive to its FFO per share since it's using proceeds from property dispositions that it sold at lower cap rate than the interest rate of this debt, so it should expand its FFO on a per share basis. And now I'll put another chart on the screen where you'll see the expectations for interest rates in the coming years, and it's quite clear that it's expected that rates will drop down significantly in Europe, just like in the US, but potentially to even lower levels, and as a result of this we expect cap rates to compress a bit, property values to improve, and this should go a long way for Branicks earnings already in the near term. The management think that LTV will drop below 50% in 2025. I think that might be a bit ambitious, but even if that's not the case, I think it's quite likely that we'll see LTV drop down closer to 50 to 55%. I think that as its LTV drops down to that level and the company announces more asset sales, pays off more of its debt maturities, it will eventually be in a position to refinance and extend the debt of 2026. And if they pull that off, then the stock could easily triple, because even if it tripled from here, it would still be just around at 6 euros per share, which is a very steep discount relative to the net asset value of 17 euros per share. So it would still trade at an over 50% discount to its net asset value, which is fair given that the company would still be quite risky even in that situation, but it would reflect the lower risk of the company going bankrupt. And I think that this is really the base case outcome for this company, and for this reason we are investing in it at High Yield Landlord, which is my REIT newsletter. We are fully aware that the company is quite risky, but we like the risk to reward because we think that it's much more likely that the company survives than that it goes bankrupt. And if it survives, we expect it to more than triple. It could even quadruple from here. And so the risk to reward is very attractive, and it's just one position as part of a well-diversified portfolio of similar plays. And so some of them will not play out and we'll lose money on them, but some others will work out really well and more than make up for these losses. And we expect the average performance to be very good over time. And if you want to access our full portfolio, by the way, you can join us for a 2-week free trial. It will be the second link in the description of this video. Then the second REIT I'm going to discuss is called Unity Group. Its ticker symbol is UNIT. This is an infrastructure REIT that owns fiber networks and currently trades at just around 1/3 of its net asset value and just around 5 times its free cash flow. And the reason why this REIT has historically been so cheap is because it's heavily exposed to a single tenant. Their relationship is very messy. I'll get back to that later. And on top of that, the REIT is very heavily leveraged, and therefore its solvency in a way is at the mercy of its tenant. But things are now changing rapidly. Earlier this year, Unity announced that it would merge with its biggest tenant called Windstream, combining both companies together. The initial reaction to this was quite negative and the share price of the company crashed down, but you should keep in mind here that Unity had rallied in the weeks before this announcement because there were rumors that the company might get bought out at a large premium to its latest share price. And so following the announcement of the merger, the market simply removed those gains and it caused the share price to crash. The market was hoping for more because the management has long talked about strategic alternatives, including the potential for selling the entire company to some private equity group or even another REIT. And there were even rumors of a group called Zayo attempting to buy out the REIT at $15 per share. And so because of this, the market was quite disappointed that the announcement wasn't about a buyout, but it was rather the merger of the two companies. And now it appears to think that the market is losing hope in an eventual buyout. But after doing some work on the deal, I actually think the opposite. I think that the future potential deal is now more likely than ever, and I think it's much more likely as a result of both companies combining together, and I think that this merger could be part of something much bigger that just hasn't been announced yet. Earlier I put this screenshot of a Wall Street Journal article that showed that Zayo was interested in buying Unity, and if you read the full title, you'll see that they were also interested in buying Windstream, and this makes sense because buying just one of these two companies will be very risky since they had a messy relationship. And as a reminder to you, if you're not familiar with the whole context here, essentially Windstream is the biggest tenant of Unity. Unity generates the vast majority of its revenue from Windstream, and their lease will expire in 2030. Windstream is arguing that the rent will drop significantly in 2030, but Unity is arguing that will remain at the same level or even increase a bit. And so they've been going through this dispute, and unfortunately their current lease agreement actually is supposed to regulate how the rent will be reset in 2030, but it appears that there was a mistake made in the lease, and as a result both parties have valid arguments for what the rent level should be going forward. And so if a group like Zayo attempted to buy out Unity, it would be in a very risky situation, not being able to control Windstream. Maybe in 2030 the rent level would drop significantly because of this agreement, and so to reduce risk it needed to buy both companies companies, but that wasn't possible. But now both companies are merging together, which will make it a lot easier to potentially monetize the asset, because it removes entirely this dispute over the lease, and that is why I think that this merger is worthwhile. Another interesting thing to mention about this merger is that the activist investment firm Elliott is behind it. And if you're not familiar with Elliott, this is an investment firm that's very commonly buying big stakes in public companies and then pressuring them to make major changes, such as selling assets or selling themselves out completely to private equity. They do that occasionally with REITs, and as an example, not too long ago they also initiated a big stake in Crown Castle, ticker symbol CCI, which is a cell tower REIT. And the interesting thing here is that Crown Castle happens to also own a major fiber networks portfolio, and one of the big demands from Elliott that's really a main aspect of the investment thesis is that the fiber networks are undervalued, and by selling them they could unlock a lot of value for shareholders. And so it's very interesting to see that they're investing in Crown Castle for their fiber networks. Now they're also investing in Unity for their fiber networks. But a big difference is that Unity is even cheaper than Crown Castle, and according to some calculations from the analyst Dame Baller from the company Second Market Capital, which is another REIT investment firm, he estimates that the fiber networks of Unity could be worth up to $19.4 billion, which represents about $50 per share. And I think that might be a bit ambitious again, but it shows you why the management of Unity wasn't ready to sell itself for $15 per share, and why they argued that this would undervalue the portfolio, and it's simply because it is true. So to put it simply, merging both companies together now removes the lease dispute, which will make it easier to potentially monetize the asset later. It also allows the company to reduce its leverage a bit. It has some synergies. Elliott is now involved, which will likely improve the management of the company, hold them more accountable. And you take all of this into account, I think that this actually increases the likelihood of a future buyout, especially since there were already some potential buyers that were interested in buying both companies. Now that they are together, the whole process would be a lot simpler, and expecting a tripling of the share price here isn't totally unreasonable in my opinion, given how heavily discounted the stock is today. Keep in mind that just a couple of years ago, Unity was commonly trading at $15–20 per share, and even back then a lot of value investors were arguing that the stock was too cheap relative to other infrastructure REITs. Then they ran into these issues with their biggest tenant, but those are now getting resolved. They also had too much leverage. The leverage is now coming down. They also expect to convert from a REIT to a C Corp, which will give them more flexibility, allowing to retain all of their cash flow in-house to reinvest in growth and organically deleverage the balance sheet. So I think the company is now going in the right direction. I think a buyout is quite possible, and I like the risk reward once again here. I think that this play is quite a bit safer than that of Branix. The upside potential perhaps is not quite as significant. I think it's more likely that this company will double rather than triple in the coming years, whereas Branix could easily triple. But even then, I really like the risk reward, and that is why we own a position in our portfolio at High Yield Landlord. Finally, once more, if you want to access our full portfolio of hand-selected REITs to maximize gains in the recovery, you can join us at High Yield Landlord for a 2-week free trial. It will be the first or the second link in the description of the video. And if you thought that this content was valuable, I would really appreciate if you click the like button and subscribe to the channel. That helps me to keep on growing. Thanks so much in advance. See you at my next one. Bye-bye.